Hello and welcome back to the channel, your go-to source for demystifying complex market concepts and uncovering intriguing stock data. Today, we're diving deep into the world of hard-to-borrow stocks, focusing our spotlight on a specific microcap that has recently caught our attention, AMSS. We'll break down what makes AMSS stand out on our screens, what the astonishing cost-to-borrow numbers mean, and critically, what factors you need to consider. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/stock ticker. Let's talk about AMSS. This is a microcap stock, meaning it has a relatively small market capitalization, often associated with higher volatility and lower liquidity. Our data shows an estimated float for AMSS of just 5.3 million shares. Now here's where things get intriguing and a bit unusual. Over the past day, 5 days, and even the last 30 days, AMSS has shown absolutely no price change, holding steady at plus 0.0% across all those timeframes. Your chart flatlined furthermore, its trading volume has been 0 shares today and 0 shares on average over the last 30 days. Yes, you heard that right, 0. Despite this lack of recent market activity, AMSS registered a composite squeeze score on our internal scale of 41.8 out of 100. This score factors in various metrics, including cost to borrow, float size, and momentum, which we'll discuss. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why should you care? Imagine you want to short sell a stock, meaning you're betting its price will go down. To do this, you first need to borrow shares from someone else, typically through a broker. This isn't free. You pay a fee, much like renting a car. The cost to borrow is this annualized fee. When a stock's CTB shoots up, it indicates a high demand to short the stock, a very limited supply of shares available to borrow, or both. These fees can easily exceed 100% annually, and in extreme cases, even hundreds of percent, because the supply and demand dynamics for borrowable shares are completely different from the supply and demand for shares simply to buy or sell. A high CTB means short sellers are paying a premium, taking on significant risk, and it can become incredibly painful for them if the stock price starts to rise. Why this stock is hard to borrow right now? For AMSS, our data shows an astonishing annualized cost to borrow fee of 565.6%. Highlight CEB number, let that sink in. This means short sellers currently borrowing AMSS shares are theoretically paying over 565% of the stock's value per year just to maintain their positions. Combine this with an estimated float of only 5.3 million shares, and you have a recipe for extremely tight borrower supply. The exact number of shares currently available to borrow is unknown, but a CTB this high strongly suggests availability is severely constrained. Now, the big caveat here, remember that 0 volume and 0 price action we just discussed. It's highly unusual to see such an extreme CTB for a stock with no trading activity. This could indicate a very illiquid market where even a small theoretical demand to short creates outsized borrower fees, or perhaps a temporary data anomaly. It certainly makes AMSS an interesting case study even without recent price movement. Squeeze mechanics explain. So, if a stock like AMSS were to suddenly see renewed interest and volume, how could a short squeeze unfold? A short squeeze happens when a stock's price begins to rise, causing short sellers to panic and buy back shares to close their positions. This buying action further pushes up the price, creating a domino effect. With a small float like AMSS's 5.3 million shares, any significant buying pressure can have an outsized impact, leading to rapid price appreciation. When short sellers are paying over 565% annualized to borrow shares, they have a strong incentive to close their positions quickly if the stock moves against them. The shrinking supply of borrowable shares, combined with an increasing share price, creates a feedback loop where short sellers are forced to buy, accelerating the rally. However, it's crucial to understand, a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock's value will ultimately decline, and they are willing to pay a hefty price to maintain their bearish bet. Dilution risk check. An important factor to consider in any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, effectively increasing the total number of shares outstanding. This can happen through various means such as secondary offerings. More shares mean less scarcity, which can completely offset a negative short squeeze thesis, even if the cost to borrow is extremely high. New shares hitting the market provide additional supply that short sellers can potentially use to cover their positions, or simply dampen any price appreciation from buying pressure. In the case of AMSS, we found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days, which is a positive sign for short squeeze enthusiasts. Before we continue, let's quickly reiterate our disclaimer. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For AMSS, given the current unique situation of extremely high CTB but zero volume, the key things to watch for would be any change whatsoever in trading activity. Show chart, zoom in on volume bar. 1. Volume resurgence. Any significant increase in daily trading volume would be the first signal that actual market interest is returning. Without volume, even a high CTB stock cannot experience a squeeze. 2. Price action. Look for AMSS to break its current plus 0.0% streak. Any sustained positive price movement, even on small volume initially, could start to put pressure on short positions. 3. Borrow desk data. If accessible, monitor the availability of shares to borrow and changes in the cost to borrow. A further shrinking supply or even high CTB would intensify the pressure. 4. News and catalysts. Given it's a microcap, any company-specific news, announcements, or sector developments could act as a catalyst. Remember, microcap stocks like AMSS are inherently more volatile and less liquid, which amplifies both potential rewards and risks. AMSS presents a fascinating case study, with its staggering 565.6% cost to borrow and incredibly low estimated float of 5.3 million shares. While these numbers often scream potential short squeeze, the complete absence of recent trading volume and price action makes it a truly unique situation. It highlights that high CTB alone is not enough. Market activity and a catalyst are crucial for squeeze to materialize. Our dilution check shows no recent risk, which removes one hurdle, but the liquidity situation remains paramount. As always, do your own thorough research. Understand the risks involved in microcap investing, especially with illiquid stocks. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments below what other stocks or market topics you'd like us to cover next. Your questions and insights help us tailor our content. Thanks for watching, and we'll see you in the next one.